Welcome back to the channel, guys. My name is Derek Coffey, and I'm the founder of FWP. And first things first, I hope you all had a wonderful Thanksgiving. I know I did. I personally have a lot to be thankful for this year. One of those things is all of the subscribers that I have. We're almost to 8,000, so if you haven't hit the subscribe button yet, go ahead and hit it. But now that the shameless plug is out of the way, let's get into today's topic, which is health insurance. When you're looking to retire at 55, one of the biggest humps for you to get over is what you're going to do about health insurance. For a lot of people, they don't understand the options that are available to them, and there are quite a few. In this video, we're going to go over 3 of the most popular options, and we're going to spend a significant amount of time on number 3, those marketplace plans. We're going to go into what you need to consider. We're going to go into how you actually go about getting a quote for it online. That way you can make the best decision for you when it comes to your health insurance. Stay tuned. The stress that you're feeling about potentially retiring early and the health insurance conundrum that you find yourself in all comes down to about 3 main reasons. Number 1 is the cost. You don't know how much it's going to cost you to have your health insurance. If you're retiring at 55, you're covering yourself for 10 years before Medicare kicks in. So not knowing what that cost is going to be is going to weigh on you, especially when it comes to making that decision to leave a job that probably provides your health insurance for you. In most situations, your employer is covering half of that cost. So you could take the amount of money that's coming out of your paycheck, multiply it by 2, and that's how much it's going to cost you on a monthly basis. But you shouldn't let cost be the only thing to scare you away, because there's ways around it. The second thing that you're stressed about is the time. As I just mentioned, you have 10 years from the time you retire until you're eligible for Medicare. Having coverage in place over that entire period of time is paramount to making sure your retirement plan is going to work. But there are options available to you. The third and final thing that's probably stressing you out is the confusion. If you've been on the same health insurance plan through your employer for years, then you understand what you have available to you. If you leave that plan and then move on to maybe a marketplace plan or a health share plan, you're not sure exactly what you're going to get. So all those 3 things added together is why you're feeling stress about your decision to retire and what you're going to do about your health insurance. But keep in mind, you have options. The first option that's most readily available to you is COBRA insurance. If you're not aware of what COBRA is, it's basically an extension of your current plan that you have through your employer. Now, there are some instances where using COBRA insurance makes sense. The first of which is you retire in the middle of the year. Not everyone waits until December 31st of the year to retire. Some of you may want to call it quits before summer. That way you can start taking your vacations. Well, if that's the case, there are some advantages to moving on to COBRA. First, you get to keep the same doctors. You have the same coverage, all of the things that you've been used to for the last however many years you've been on that plan. The other thing is you don't have to deal with the marketplace. You don't have to worry about going out and shopping for a new plan to replace what you had. So COBRA does make for a great short-term option. You don't have to worry about the changes in coverages. You don't have to start at 0 when it comes to fulfilling your deductibles again. It just allows you to get through the short term without any major changes to your life. Now, there are some cons to being on COBRA insurance, and the first of which is it's expensive. The coverage that you currently have through your employer is probably paying at least half of that amount. So now you're on the hook for the whole thing. Because you don't work there anymore, your employer doesn't have to pay for you. So if you want to extend that coverage, you have to pay for it all. In addition to that, you're probably going to be subject to some type of administrative fee, which could be upwards of 2% of the premium that you pay. So the expense of the COBRA plan is not going to be the most budget friendly. Next, it only lasts 18 months. In some situations, you might be able to push it out 36 months, but it's not a great long-term option for retirees. At some point, you're going to have to leave that plan and move on to something else. So use COBRA if it fits what you're trying to accomplish. But if you're planning to retire at the end of the year, then I really wouldn't bother with this unless it just absolutely makes sense for you to stay on your current plan. The second option that's available to you is a Medi-Share plan. Now, what I want you to keep in mind is that Medi-Share is not insurance. They function quite a bit differently. But if you're a healthy individual, then being on a Medi-Share plan could be the right answer. If you don't go to specialists on a regular basis or take prescription medication on a regular basis, then a Medi-Share plan could be the right option because it's typically much more budget friendly than anything else. Now, what you have to keep in mind about those lower monthly premiums is that you may be out of pocket more if something catastrophic happens. As long as you're not utilizing the doctor's office outside of an annual checkup, or maybe if you have the sniffles a couple of times a year, then consider joining a Medi-Share plan. But before you do that, make sure you weigh out the pros and cons. A couple of the pros of the Medi-Share plan is that it is very cost efficient for healthy individuals. If you're not going to the doctor, then paying those lower monthly premiums for just that base level of coverage that you really need is going to be a good choice. And it's going to be much cheaper than COBRA. As we just went over, your COBRA premiums are going to be extremely high just to continue the coverage that you have. If that's something that you don't want to deal with, then consider a Medi-Share plan. But with those pros, we also have to keep in mind the cons. The first of which is that you can be excluded if you have a pre-existing condition. Remember, Medi-Share is not health insurance. It's not regulated the same. Under the Affordable Care Act, health insurance plans have to cover pre-existing conditions. With Medi-Share plans, they don't. The other thing you have to keep in mind is that a Medi-Share plan isn't really meant to be a long-term option for retirees. As you get older, your healthcare needs are going to increase, and you want to make sure you have the right coverage for you and your situation. So a Medi-Share plan can be a great option in the short term, but I wouldn't make it my long-term play getting me to Medicare. The third and final option that's available to you is a Marketplace plan. And the reason that I put this at the end is because it's going to be the most applicable to the majority of you that plan on retiring at 55. Marketplace plans are going to be most likely the most budget-friendly for the coverage that you're going to get. And the reason this is because of how your premiums are calculated. Your premiums are based on your modified adjusted gross income. For most of you, if your financial picture is fairly simple, your modified adjusted gross income is going to match your adjusted gross income that you see on your tax returns. The lower your MAGI is, the lower your monthly premiums are going to be for your health insurance. It doesn't matter how much money you have saved. You could have $500,000 saved. You could have $5 million saved. Your net worth has no bearing on what you pay for your health insurance. It's all based on the income that gets reported. The way that the Marketplace helps you keep your health insurance premiums low is through subsidies. Depending on your MAGI, if it falls between 100 and 400% of the federal poverty limit for your household size, then you're going to be eligible for a subsidy. This subsidy helps lower what you pay every single month. To take it a step further, if your MAGI is between 100% and 250% of the federal poverty limit for your household size, you could be eligible for cost share reductions. If you go with a silver level plan, then your deductibles and out-of-pocket maximums are going to be reduced as long as your MAGI falls within that 100 to 250% range. So based on your income and how you structure that income, you could set yourself up to pay very little for your health insurance. So what does the 100 to 400% of the federal poverty limit look like? Well, I broke those numbers down for you. So what you see on the screen is a breakdown of the federal poverty limit levels based on your household size. Now, I'm going to work on the assumption that we're talking about a two-person household, assuming you're married. If you're single, then you need to work with the one-person household. But if we're married, then we have that extra person that we can kind of lean on, and it gives us a little more wiggle room. So in 2025, for coverages in 2026, the federal poverty limit for a household of two is $21,150. So 100% of that is $21,150. 250% of that is $52,875. If you have your assets saved in the appropriate locations, you could easily keep your taxable income to $52,875. As long as you do that, your health care is going to be very, very cheap, at least compared to someone at the 400% level. Once we get to the 400% level, we're talking about $84,600 a year of income, or MAGI. You're not going to be eligible for those cost share reductions, but you're still going to be eligible for some level of subsidy. This is what we mean by getting over that hump of health insurance. There are ways to save money on your health insurance costs. Now, if you need to bring in more than $84,600, then yeah, you're not going to qualify for those subsidies. You could still use a Marketplace plan or any of the other options that we've been over, but for most of you, if you're retiring at 55, your income sweet spot is going to be somewhere between $40,000 and maybe $60,000 or $70,000. So if that's the case, then you have a lot of options available to you, and I'm going to show you why. What you see on your screen is the Virginia Health Insurance Marketplace website. If your health insurance is handled at the state level, you probably have a website similar to this that you're going to go to figure out how much your health insurance might cost. If your state doesn't handle its own health insurance system, then you're going to go to healthcare.gov to figure out what your health insurance is going to cost. But the process of figuring out what that cost is going to be is pretty much the same. So if you're in the state of Virginia, you're going to go to this website, you're going to go to Get Covered. We're going to browse for health and dental plans. I'm not going to put in dental for this video. We're only focusing on health, but if you need dental care, make sure you get a dental plan. But what we do is we get to this next page where we put in the coverage year. We're looking for 2026 because we're in open enrollment season. We're going to put in where we live, and this is all based on the zip code. So I put in the zip code. And then in section 3, we start building our household. We're going to assume it's a household of 2, a married couple. We're going to put them both in as being 55 years old. They were born in 1970, 2025, they hit 55, now they're calling it quits. So we have our applicant, we have our spouse, they're both 55, they're both seeking coverage. The last piece of information that the website needs is what their MAGI is going to be. The first thing I want to show you is what it's like in that 100 to 250% range, because I want to show you those cost share reductions. We're going to hit continue, and this is going to tell us what our estimated subsidy is going to be. So on a monthly basis, our subsidy is $1,599. Now, what you have to keep in mind is these subsidies are based on a silver level plan. If you had to pay for this plan that the subsidy is based on out of pocket, it would cost you $1,802 a month. So this subsidy is extremely valuable when it comes to you getting affordable health care. The other thing you want to keep an eye out for are these lower out-of-pocket costs. Because we're under that 250% federal poverty level number, then we're eligible for cost share reductions. This is going to lower copays, it's going to lower co-insurances, it's going to lower deductibles, and ultimately those out-of-pocket maxes. And you're going to see that shortly. So we hit next, skip to view plans, and we can see all of these plans that are available to us. Now, the first thing that I want to show you are the bronze level plans. No, this is not AI, this is not made up, this is not a joke. There are bronze level plans if you're bringing in $40,000 of modified adjusted gross income where you're paying less than $1. And as a matter of fact, I think all of them are less than $1. Again, it's not made up. This is real. Now, what I want you to keep in mind is these bronze level plans, you're going to have very high deductibles. On this plan specifically, it's $15,000, and then your out-of-pocket maximum is $20,000. So if something catastrophic happens, you're going to be out of pocket for $20,000 of that. So if you're in this area where you qualify for a cost share reduction, a bronze plan is probably not going to be the best option for you. What we're going to look for is a silver level plan. The silver level plan is where the cost share reductions come into play. Yes, the monthly premiums go up. If we go down to a medium expense plan, then you're going to pay $228 a month for this plan. But what you have to take a look at is that your primary care visits are only going to be $15. Generic drugs are only going to cost you $10. Your annual deductible is $900. And then if you have a major medical emergency, then your out-of-pocket maximum is only $6,700. So you're paying $2,500 for the year, but the worst you're going to have to pay out of pocket is an additional $6,700. That's much cheaper than the $20,000 that you would have to pay if you were on a bronze plan. This is the importance of knowing where your income is going to come from and how much you need. If you're able to sustain yourself on this $40,000, then your health insurance is really cheap. Now you may be thinking to yourself, how am I only going to make it on $40,000? Well, if your money's invested or saved in different types of accounts, you could very easily make your modified adjusted gross income $40,000. So that's what it looks like with the cost share reductions. If we go back and edit the info to where we're making more than what would put us eligible for those cost share reductions, then the costs are going to be a little bit different. So let's say you're planning on bringing in $60,000. That puts us above that 250 limit. So you'll notice on this screen that we're only getting showed what our subsidy would be. The subsidy is still really good, a little over $1,300 a month, but we're not getting those cost share reductions. We're going to move on to seeing the plans. Again, we'll go back to the bronze first just to show you how cheap this can be. Having your deductible around $5,800 per person, you're going to pay $160 a month. Yes, you're still going to be out of pocket over $20,000. But if you can't get those cost share reductions, your monthly premiums can still be fairly cheap. We move from the bronze level to the silver level plan. And what you'll notice is that your monthly premiums go up by $300, but your out-of-pockets stay the same. You're not really helping yourself by moving up to that silver level plan. So now the argument's going to be is, should I be on a bronze plan or should I be on a gold plan? Because you don't qualify for those cost share reductions, a gold plan could still be in play. But you have options where your deductibles and your out-of-pocket maximums aren't as high as the bronze. Even over here, you're paying $438 a month, but your out-of-pocket maximum is $15,000. It's over $5,000 cheaper. Yes, you're paying $300 more a month, but you still come out ahead if something major happens. So when it comes to figuring out what you're going to do about health insurance, you have to weigh out all of these options to make sure you're picking the one that is not only the cheapest, but it gives you the quality of coverage that you need for your specific situation. If you stuck around this long, I greatly appreciate it. I know this video is a little long-winded, but I really want to drive home the point that you shouldn't delay your retirement just because of health insurance. Sure, there are those outlier situations where you might want to consider working until you can get on Medicare. But for most of you, retiring at 55 should not be held up just based on your health insurance. There are options. If you're able to control your income and that modified adjusted gross income, you can give yourself plenty of cheap options, but give you quality coverage. And that's what we always want. We always want a good deal. The system is there for you to use it. If you control your income, you can use that system to your full advantage. If you guys are liking this Retire at 55 series, please stay tuned. The next video is going to be all about that income control and understanding what your taxes are going to look like. Taxes can become a big problem later on in your retirement, so making sure that you can control them is not only going to help with your health insurance premiums, but it's also going to help with your tax bill as you live on. I want to thank you guys so much for tuning in. If this video or any of the other videos that I've put out has provided you value, then hit that subscribe button. If you have any tips or tricks about retiring early and getting that cheap quality health insurance, leave us a comment below. That way you can help out other people. But I want to thank you guys again so much for tuning in. I'll talk to you soon.